It is talk of the town about the infamous Vodafone Tax dispute which the International Court of Arbitration at Hague ruled in their favor. Let us understand the whole Vodafone Tax dispute saga. Hutchison Telecommunications International Limited, that is Hutch, is a foreign company registered in Hong Kong and was the leading telecommunication operator in India. In 2007, Vodafone, a Dutch-based company, agreed to acquire the controlling stake in Hutch SR. Hutch SR was the joint venture between Hutchison and SR Group. Looking at this simple transaction, the question arises, how did it lead to a demand of 22,000 crore of income tax? CGP Investments, registered in the Cayman Islands, Mauritius, a tax haven country, was a wholly owned subsidiary of Hutchison Telecommunications, which held in total 67% stake in Hutchison SR Limited, which is an Indian company. The investment was routed through the Mauritius for tax planning purpose. In 2007, Vodafone International, registered in Netherlands, purchased 100% shares in CGP Investments from Hutchison Telecommunications for $11.1 billion and effectively acquired 67% stake in Hutchison SR India's business. This impelled the Income Tax Department into question how in this whole offshore transaction that actually involved the sale of assets in India and also the source of income in India is not subject to income tax. Therefore, the Income Tax Department asked the Vodafone to pay tax on the capital gain arising due to the sale of shares and demanded why tax was not deducted at source while making the payment to Hutch. But the Vodafone disagreed as the transaction involved the sale and purchase of shares of a foreign entity which is outside the purview of income tax, and therefore they approached the Bombay High Court and filed a writ petition. The High Court dismissed their writ petition and held that the dominant purpose of the transaction was to have controlling interest in the Indian entity and the whole transaction was routed through Mauritius to avoid the income tax. Vodafone contested this demand and in 2012 won against the tax department before the Supreme Court of India. The apex court held that sale of shares in question to Vodafone did not amount to transfer of capital asset as per the provisions under the Income Tax Act. But the government realized that there is a big lacuna in the Income Tax Act, so they amended the relevant definition of transfer, capital asset and the income deemed to arise in India in the Act retrospectively, that is, making these amendments applicable from 1962, leading to the Vodafone transaction liable to income tax. It is just like they say, death and taxes are inevitable. But Vodafone used its last resort and contested the tax liability by initiating arbitration proceedings against the government in accordance to the Article 4.1 of India-Netherlands Bilateral Investment Treaty. It guarantees that the companies investing in the other country shall at all times be accorded fair and equitable treatment and shall enjoy full protection and security in the territory. Therefore, the retrospective amendment amounted to gross violation of fair and equitable treatment promised. On 25th September, the Vodafone won the decade-long case in the International Arbitration Court, but now the question arises, will the Government of India contest against this judgment which could malign the investor-friendly environment of India? Thank you for watching the video. Please share your reviews in the comments section.